You're paying 400% more for life insurance than you need to, and I'm not exaggerating. A 35-year-old non-smoker in good health can get a $1.5 million 20-year term policy for as low as $60 a month. But the average person pays $300 a month for the same coverage because they bought the wrong type, whole life or universal life, from a slick agent who earned a fat commission. That's $240 a month wasted, or $57,600 over 20 years. That's a down payment on a house, a fully funded Roth IRA for a decade, or a brand new Tesla. And the worst part, most people don't even know they're being ripped off because insurance companies design these products to confuse you. Today I'm going to show you exactly how to spot this trap, how to calculate your true cost, and how to save thousands without sacrificing a dollar of coverage. Why is this so urgent right now? In 2025, the average cost of a 20-year term life policy for a healthy 35-year-old dropped to its lowest point in history, about 0.08 cents per $1,000 of coverage per month, according to the Life Insurance Marketing and Research Association, LIMRA. That's a 15% decrease from just 5 years ago. Meanwhile, whole life insurance premiums have actually risen 8% over the same period because of low interest rates and higher administrative costs. Yet, 60% of new policies sold in 2025 were whole or universal life, according to the National Association of Insurance Commissioners, NAIC. That means millions of families are locking into expensive permanent policies when a cheap term policy would cover their needs and leave them with thousands more to invest. The data is clear. The insurance industry is banking on your ignorance. Think of your life insurance like a fire extinguisher. A term life policy is a $20 fire extinguisher you buy for your kitchen. It's cheap. It works perfectly for the one time you might need it, your working years when you have a mortgage and kids. And when the risk is gone, you throw it away. A whole life policy is like buying a $1,000 fire extinguisher that comes with a lifetime maintenance contract, a monthly subscription to a fire safety newsletter, and a promise that you can use it as a decorative piece. It still puts out fires, but you're paying a fortune for features you never asked for. And when you try to sell that expensive extinguisher later, you'll get back less than you paid. Stick with the $20 one. It does the same job. Number 1, the commission trap. Insurance agents earn 50 to 100% of your first year's premium as commission on whole life policies, but only 5 to 10% on term life. That's why they push permanent policies. A $300 a month whole life policy gives the agent a $3,600 commission up front. The same coverage in term costs $60 a month and pays the agent only $72. Follow the money, your money. 2, the cash value illusion. Whole life policies build cash value that grows at 2 to 4% annually, but you lose all that growth to fees and commissions in the first 5 to 7 years. Meanwhile, the S&P 500 has averaged 10% returns over the last 30 years. If you buy a 300-month term policy for $60 and invest the $240 difference in a low-cost index fund, you'd have over $150,000 after 20 years. The whole life cash value? Maybe $30,000. 3, the lapse rate disaster. According to the NAC, 30% of whole life policies lapse within the first 10 years. When you lapse, you lose everything. The cash value is eaten by surrender charges. Term policies have a 5% lapse rate because they're cheap and simple. You're statistically 6 times more likely to lose your whole life policy than your term policy. 4, the inflation erosion. A $1 million whole life policy you buy at age 35 will be worth only $500,000 in real purchasing power by age 65, assuming 3% inflation. Term insurance lets you buy a larger face amount for the same premium so you can actually maintain your family's standard of living. A $1.5 million term policy costs the same as a $500,000 whole life policy. 5, the investment opportunity cost. The average whole life policyholder pays $2,400 per year more than they would for term. Over 20 years, that's $48,000 in extra premiums. If that money had been invested in a simple 60-40 stock bond portfolio, it would grow to $130,000. The whole life policy's cash value? $40,000. You're losing $90,000 just by choosing the wrong product. Here's what you do right now. Go to a site like Policy Genius or Term for Sale and get a quote for a 20-year term policy equal to 10 to 15 times your annual income. If you're a 35-year-old earning $100,000, that's $1 million to $1.5 million. Compare that to what you're paying now. If you have whole life, cancel it, but only after your new term policy is approved and active. Then take the $240 a month you save and put it into a Roth IRA or a taxable brokerage account in VOO. You'll be worth 6 figures more in retirement. And if you want to see the exact math on how to build that $150,000 in 20 years, click the video right here.